Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the confusing world of corporate finance by diving deep into their official filings. And today we're going to decode some important financial reports from Fidelity Newbury Street. Trust their latest filings give us a really clear picture of how two of their money market funds have been doing over the last year. It's packed with numbers and details about where their money comes from and where it goes. So let's break it all down and see what story these financials are actually telling us. If you appreciate getting straight insights from corporate documents like this, make sure you are subscribed and hit that notification bell. We also have a Discord community where we dive deeper into these topics linked in the description below, so come join the conversation. So what we have here is a filing called Form N-CSR, which is essentially an annual report for registered management investment companies. It is like a yearly checkup for these funds that tells investors all about their performance, their costs, and what they've been investing in. Today we're focusing on two main funds, the Fidelity Treasury Money Market Fund and the Fidelity Tax Exempt Money Market Fund. These are both money market funds which are generally considered pretty safe places to park your cash, aiming to provide stability and easy access to your money while earning a little bit of interest. One of the first things any investor wants to know is how much it costs to have their money in a fund, and this report breaks it down nicely for the Fidelity Treasury Money Market. For example, a hypothetical $10,000 investment would have cost around $43 for the year. They also show different classes of shares within the same fund, because sometimes there are slight differences in fees or services for the daily money class of the Treasury Money Market Fund. That same hypothetical $10,000 investment cost about $71. And then for the Capital Reserves class of the Treasury Money Market Fund, that same investment cost about $97. This shows you how those fee differences can add up even for a money market fund. Now let's talk about how big these funds are. As of the 31st of October 2025, the Treasury Money Market Fund was massive, managing over $44 billion. That is a lot of money, and it tells us these funds are very popular with a lot of investors. So what are they investing in? Well, for the Treasury Money Market Fund, the biggest piece of the pie, a whopping 73.4% of their assets were in US Treasury obligations. This is about as safe as it gets in the investment world. These are essentially IOS from the US government. Another big chunk, around 29%, was in repurchase agreements or repos. These are short-term loans where securities are sold with an agreement to repurchase them later, generally considered very low risk. Let's take a quick peek at who they're doing these repurchase agreements with. They've got agreements with big names like JP Morgan Chase Bank NA, Barclays Bank PLC. This is normal for funds of this size dealing with major financial institutions. Looking at their actual investments in treasury bills, you can see a lot of them are short-term, maturing in early 2026. For example, they hold millions in US Treasury. Bills maturing on the 13th of January 2026 and the 15th of January 2026. This shows they are focused on very short-term, very safe investments. And what is the result of all this investing in safe assets and managing costs? Means that for the Capital Reserves class of the Treasury Money Market Fund, the net asset value, or NAV, per S-Hair remains steady at $1. It's designed to be stable, like a bank account. Even though it is a money market fund, they still report a total return for the year ending the 31st of October 2025. For the Capital Reserves class, it was around 3.51%, which is pretty good for a safe investment. The report also details the expenses charged to investors for the Capital Reserves class of the Treasury Money Market Fund. The expenses after any fee waivers were about 0.95% of the average net assets. Now let's switch gears to the Fidelity Tax Exempt Money Market Fund. As of the same date, the 31st of October 2025, this fund was a lot smaller, managing about $3.8 billion. Unlike the Treasury Fund, this one invests in different types of assets. About 33.8% of its assets were in what is called tender option bonds. Or TOBs, these can be a bit more complex. But in simple terms, they're like bonds that can be put back to the issuer under certain conditions. Another major investment, around 33.3%, was in variable rate demand notes, VRDNs. These are also designed to be quite liquid, and their interest rates can adjust. They also hold about 12.6% in municipal securities. These are bonds issued by states and cities to fund public projects. The key thing here is that the interest earned from these is generally exempt from federal income tax, which is why it is called a tax-exempt fund. A smaller portion, around 8.4%, was in commercial paper, which is basically short-term IOUs issued by corporations. Interestingly, they also invest in other money market funds, specifically Fidelity Central Funds, which is an affiliate. This is a common practice for money market funds to manage their cash and short-term needs. Just like the Treasury Fund, the tax-exempt money market fund also aims for stability, and its NAV per S-Hair remained at $1. For the Capital Reserves class of the tax exempt, fund, the total return for the year was about 1.90%, again showing that these funds prioritize safety and stability. The expenses for the capital reserves class of the tax-exempt fund were around 0.95% of average net assets. Now let's look at the income and expenses for the Treasury Money Market Fund. It earned over $2 billion in interest income for the year, but it also had significant expenses totaling over $216 million. This resulted in a net investment income of over $1.8 billion for the year. The report also shows how the funds make distributions to shareholders. For the Treasury Fund, they paid out over $1.8 billion in distributions. For the year, it is important to remember these are typically income distributions made up of the interest earned. For the tax-exempt fund, the investment income was much smaller at about $108 million, with expenses around $13.5 million, leading to a net investment income of about $94 million. And for this fund, they distributed about $94 million to shareholders. This report also includes a stamp of approval from PricewaterhouseCoopers LLP, their independent auditor. They confirmed that the financial statements present fairly the financial position of these funds, and that they conducted their audits according to the standards of the PCAOB. A significant part of this filing is the Board of Trustees review and approval of the investment advisory contracts and management fees. They go through a really rigorous process each year, looking at everything from the quality of services provided to how competitive the fees are compared to similar funds. They considered the nature, extent, and quality of services, the investment performance of the funds, the competitiveness of the management fees and total expense ratios, the costs of services and profitability for Fidelity, and whether economies of scale are being shared with shareholders. For the tax-exempt money market fund premium class, the total expense ratio ranked below the competitive median for the total peer group, but above the median for the asset size peer group. It's a complex comparison because these funds have different structures, and there are contractual arrangements in place where FMR Fidelity's management company agrees to limit expenses to certain percentages for specific classes to keep costs down for investors. The board also examined economies of scale to see if as the funds grow larger, the cost per investor go down, and how those savings are passed on to shareholders. They concluded that economies of scale, if any, are being appropriately shared between fund shareholders and Fidelity. In my opinion, these filings from Fidelity Newbury Street Trust show two very stable and well-managed money market funds. The Treasury Fund is massive, focused almost exclusively on US government debt, keeping its risk incredibly low, the tax exempt fund, while smaller, offers a way to earn income with tax advantages, though it does involve slightly more complex investments like tender option bonds and VRDNs. Both funds maintain their $1 per share value, which is the hallmark of a money market fund. It's clear Fidelity prioritizes the safety and stability of these funds for their large investor base. The expense ratios are generally reasonable for money market funds, and the fact that the board reviews these contracts so thoroughly year after year is a good sign. The main takeaway is that these are reliable options for investors seeking low risk places to put their money. So what is your take on these reports? Do these numbers suggest Fidelity is doing a great job managing these money market funds? Or are there things we should be more cautious about? Let me know your thoughts in the comments below now. If you found this breakdown helpful, please give this video a like and subscribe for more deep dives into financial filings like this. And don't forget to join our Discord community linked in the description, where we can continue this conversation and explore even more corporate finance topics. Thanks for watching, and we'll see you in the next episode.